Hello students, welcome to my channel Rising Sun. Today we will solve illustration number 9, page 166 of 12th Commerce. Amit and Baban both are partners sharing profit and losses in the ratio 2:3 respectively. They decided to admit Kamal on 1st April 2018 on following terms. Kamal would bring capital 50,000 and 40,000 as her share of goodwill. Assets and liabilities are revalued as follows. Land and building book value is 50,000 and it has been revalued at 60,000. So there is an increase of 10,000 in the value of land and building. There is no changes in the value of plant. But as you can see, the furniture having a book value of 4,000 is depreciated by 10%. Stock is revalued at 1,10,000. So stock is increased by 10,000. So students, out of the assets, land and building and stock are appreciated. So the value of land and building is increased and the value of stock is also increased. But at the same time, furniture is depreciated. So there is a reduction in value of furniture. And there is a provision of RDD, bad and doubtful debts, 5%. So debtors will also decrease by 5%. First, we will note down the cash balance 1,10,000 in the cash account. So this is the balance brought down, 1,10,000. Cash account on the debit side, 1,10,000. This is the cash balance. Land and building. So as we have just seen, land and building is increased by 10,000. So book value of 50,000, we will note it in the assets, and there is an appreciation of 10,000. So final amount will come out to 60,000. Now since the value of the land and building is increased by 10,000, any increase in the value of the asset is recorded on the credit side of the profit and loss adjustment account. So on the profit and loss adjustment account credit side, we will write 10,000. So the journal entry is profit and loss adjustment account debit to land and building account credit. Profit and loss account adjustment account profit and loss adjustment account is credited. Profit and loss adjustment account is credited. So the journal entry is land and building account debit, land and building account debit to profit and loss adjustment account credit. So this entry indicates that there is an increase when we are debiting the asset account. When we are debiting the asset account, we increase the value of the assets, and the gain due to the increase in the value of the asset is recorded on the credit of the profit and loss adjustment account. Then plant 60,000 is as it is. There is no change in plant. So we will write the value of plant in the balance sheet with the same value, that is 60,000, outer column. Furniture book value is 4,000 and the furniture is depreciated by 10%. So book value of furniture is 4,000 and 10% of 4,000 is 400. So it will be 3,600. furniture asset is depreciated, so we have to reduce the value of the asset. To reduce the value of the asset, we credit asset account, and since there is a loss of 400 due to the reduction in the value of the asset, it will be debited to revaluation or profit and loss adjustment account. So the journal entry here will be profit and loss adjustment account debit to furniture account. Profit and loss adjustment account debit to furniture account. So when we credit furniture account, that is an asset, crediting an asset reduces the value of the asset, and the loss due to the reduction in the value of the asset is debited to profit and loss adjustment account, because debit all expenses and losses, credit all income and gains. So on the debit side of the profit and loss adjustment account, in the particular column we will write the name of the account which is credited, that is to furniture account. And in the same way here we have reduced the value of the furniture by 400. Now stock, if you can see, the stock book value is 1 lakh. The book value of the stock is 1 lakh and it is revalued at 1,10,000. So there is an increase in the value of stock by 10,000. There is an appreciation of stock by 10,000. So stock, inner column we will write 1 lakh and it is increased by 10,000. So the final value will be 1,10,000. Now the 10,000 will appear as an effect on the credit side of the revaluation or profit and loss adjustment account, because increase in value of an asset is credited to profit and loss adjustment account. Always remember that increase in the value of the asset, increase in the value of the asset, you have to credit profit and loss adjustment account, and any decrease in the value of the asset, you have to debit the profit and loss adjustment account. So all the gains due to revaluation of the assets and liabilities are credited to profit and loss adjustment account, and any loss due to the revaluation of assets and liabilities are recorded to the debit side of the profit and loss adjustment account. Debtors book value is 16,000 and there is an RDD of 5% to be maintained. So debtors we will write in the balance sheet 16,000 inner column, because we have to reduce debtors by 5%. There is a provision of RDD 5%. So 5% of 16,000 comes out to 800. So we will reduce debtors by 800. 16,000 minus 800. 15,200. Now since the debtors, again the debtor is an asset, there is a reduction in the value of the asset. Any reduction in the value of the asset is a loss to the organization or the firm, which has to be recorded on the debit side of profit and loss adjustment account. So 800 we will debit to profit and loss adjustment account. The journal entry is profit and loss adjustment account debit to RDD. Profit and loss adjustment account debit to RDD credit. Then on the liability side we can see there are creditors of 1,40,000. Again there is no change in the value of the creditors, so as it is we will write in the balance sheet. Balance sheet creditors on the outer column 1,40,000. The balances of old partners Amit and Baban are 1 lakh respectively. So 1 lakh we will write on the credit side of the capital account. Capital account will come to the capital account. In the credit side, in Amit's column I will write 1 lakh because this is the balance, and Baban 1 lakh. Now let's go to the adjustment number 1. So adjustment number 1 tells us that Kamal shall have 1/4 share in future profits. So out of 4 parts, Kamal will be sharing 1 part. So 1/4. 1/4 indicates that out of 4 parts, if you divide the profit by 4 parts, 1 part will be shared by Kamal. So what remains for Amit and Baban, that are old partners, are 3/4. So when out of 4 parts, 1 part is taken by Kamal, what remains for the old partners is 3 parts, and this is called as balance of 1. So whatever remains, whatever the balance of the profit remains after new partner is taking his share, is balance of 1. It is used in calculation of new profit sharing ratio. Now information or additional information number 2 tells that Kamal is agreed on as a partner on 1st April. So you will be preparing the balance sheet as on 1st April 2018. Kamal shall bring 50,000 as her capital. So Kamal is bringing 50,000 as capital. So journal entry for which will be cash account debit to Kamal's capital account credit. Since cash comes in the business, we will be debiting cash account, because remember the rule, debit what comes in. Cash account is an real account. So the journal entry is cash account debit. Debit what comes in, 50,000. And since Kamal is the giver of the capital, again the rule of personal account is debit the receiver and credit the giver. Kamal is the giver of capital, so Kamal's capital account will be credited. Let's post this journal entry in the respective ledger. $50,000. So first cash account is debited. So in the cash account debit side, I will write the name of the account which is credited, that is Kamal's capital account. So cash account is debited by 50,000, and in the capital account on the credit side, now because Kamal capital account will be credited, so on the capital account credit side we will write the name of the account which is debited, that is Pi cash account, and in Kamal's column we will be writing 50,000. So this was the posting of the journal entry cash account debit to Kamal's capital account credit. We have made the posting of the following journal entry, that is cash account debit to Kamal's capital account credit. So in the debit side of the cash account we have written the name of the account which is credited, and in the credit side of Kamal's account we have written the name of the account which is debited. Now goodwill, about goodwill. So Kamal is bringing 40,000 as her share of goodwill. 40,000. Now since goodwill is brought in cash, first entry will be cash account debit to goodwill account credit. First entry will be cash account debit to goodwill account credit. So on the debit side of the cash account, in the particulars column we will write the name of the account which is credited. So since goodwill account is credited, we are writing here in the particulars column cash account debit side. So cash account is debited and to goodwill account amount is 40,000. And goodwill account will be credited. So on the credit side of the goodwill account, we will write the name of the account which is debited, that is 40,000 cash account. On the credit side, in the particulars column, we write the name of the account which is debited. Then we have to pass the transfer entry of goodwill. The goodwill will be transferred to the old partners, but since the goodwill is brought in cash, we have to distribute the goodwill to the old partners capital account in sacrifice ratio. So the goodwill will be transferred to old partners in sacrifice ratio, and sacrifice ratio is old ratio minus new ratio. But since no separate new ratio is given in the problem, the sacrifice ratio will be the same as old ratio. So old ratio is 2:3, hence sacrifice ratio will also be 2:3. If there is separate new profit ratio given in the problem, then there are the chances of getting sacrifice ratio other than the old ratio. But now there is no separate profit sharing ratio given which we are calculating. The sacrifice ratio will be the same as the old ratio. First let's calculate the new profit sharing ratio. So old ratio, as they have given in the data, is 2:3. What is the formula for new profit sharing ratio? It is old ratio into balance of 1. Now we know that here balance of 1 is 3/4, because Kamal is going to share 1/4 of the future profit. So after removing one part from the total 4 parts, what remains or balance is 3 of 4 parts. So applying this formula, old ratio into balance of 1, we will calculate the new ratio for each individual partners. So Amit's new ratio will be old ratio, that is 2/3, because 2 plus 3 comes out to 5. So out of total 5 parts, Amit's share of profit will be 2. So 2/5 multiplied by balance of 1, which is 3/4. So 2 into 3 is equal to 6, divided by 5 into 4 is equal to 20. Similarly, we will calculate the new ratio of Baban. So old ratio is 2:3, means 3 parts out of total 5. So 3/5 into balance of 1 will be the same. Hence 3 into 3 is equal to 9/20. And the problem itself has mentioned the ratio of Kamal. Since Kamal is the new partner, 1/4 will be the new ratio. But since the denominator of Amit's and Baban's share, here denominator is 20, so we have to convert 4 to 20 so that we can compare and come out to a ratio. Now since we have to convert 4 to 20, we can multiply both sides by 5, so that 5 4s are 20 and 5 1s are 5. So you can see that we have common denominators now. To get the common denominator, we have multiplied both sides by 5/5. So the new ratio comes out to 6:9:5. That is out of total 20 parts. Total 20 parts, and this will be the new ratio. Now when you calculate new ratio, you can then calculate sacrifice ratio. So sacrifice ratio is old ratio minus new ratio. But now since they have not given separately the new profit sharing ratio, the sacrifice ratio will come out to same as the old ratio, that is 2:3. We will now transfer the goodwill in sacrifice ratio. The goodwill will be transferred. So goodwill transfer entry for goodwill will be goodwill account debit to old partners capital account credit. Goodwill account will be debited to old partners, that is to Amit and to Baban. So the goodwill of 40,000 will be transferred to both these capital accounts in sacrifice ratio. In a separate video, I will definitely explain you how to calculate sacrifice ratio. So here now sacrifice ratio will be 2:3. So let's calculate the amount to be distributed. So journal entry here will be goodwill account debit. So goodwill account will be debited, and in the particulars column of the debit side we write the name of the accounts which are credited. So two credit accounts are there in this journal entry. So goodwill account debit, hence we have debited the goodwill account here to Amit and to Baban. So these two corresponding credits are recorded here, written here in the particulars column. Now total goodwill is 40,000. This has to be transferred among these two partners in ratio 2:3, that is sacrifice ratio. So 40,000 into 2 upon, see 2 plus 3 is 5. So it will be 16,000, and what remains is 24,000. Okay, so let's note down here in the goodwill account debit side to Amit's capital account 16,000, and here to Baban's capital account 24,000. Hence now there is no balance left in the goodwill account. So goodwill account is debited, and old partners capital account will be credited. So we will come to the old partners capital account, and in the credit side we are writing the name of the account which is debited, that is goodwill. And in Amit's column we will write 16,000, in Baban's column we will write 24,000. In this way 40,000 is distributed among old partners in sacrifice ratio. So ultimately we can see we have credited cash account. We debited goodwill account and we are crediting the I'm extremely sorry, it's capital account. We are crediting capital account. Crediting capital account. Amit's capital account, Baban's capital account. Let's see point number 4. Land and building. Okay, we have recorded this. There is an increase in value of the land and building furniture. We have also recorded point number 5, point number 6. Now last remains is that the capital account of all the partners are to be adjusted in their new ratio. New ratio we have just calculated now, and since they want their capitals to be adjusted as new ratio, so any excess amount of the capital of the respective partners will be transferred to their loan account. So for this we have to calculate the individual partners share of capital as per new profit sharing ratio. So now we have calculated new profit sharing ratio. We will calculate the total capital of the firm first. Let's calculate total capital of the firm. The total capital of the firm is capital brought by new partner, capital brought by new partner multiplied by reciprocal of his profit sharing ratio. So you can see that new partner is bringing 50,000 as his capital, and new partner's share of profit is 1/4, which is given in the problem. So what is reciprocal of 1/4? It is 4/1. It's just opposite. Hence we multiply by 4/1. We get 2 lakh. So 2 lakh is the total capital of the firm. Now out of 2 lakh, what will be the partner's capital as per new profit sharing ratio? For that we calculated Amit's capital out of the total capital of 2 lakhs into Amit's shares. You can see here new profit sharing ratio, Amit, Baban and Kamal. So total parts is 20. So it will be 6/20. 2 lakh into 6/20 comes out to 60,000. Baban 2 lakh, that is total capital, into Baban's share 9/20 is equal to 90,000, and Kamal's share of capital, or Kamal has to bring 50,000 capital, which is mentioned in the book. So 60,000 plus 90,000 plus 50,000 comes out to 2 lakh. Now this is the capital which they will be maintaining in the business. Now 60,000 of Amit, Baban 90,000, 50,000 Kamal will appear as the capital balances in balance sheet. So let's note down these balances in the balance sheet: 60, 90 and 50. So let's come to capital account. Let's come to capital account. In the debit side, so it is 60,000, 90,000 and 50,000. This is balance carried down. This capital will appear in the balance sheet because these are as per new profit sharing ratio. We'll write here. Again there is a name of the new partner here, that is Kamal. So Amit's share is 60,000, Baban's share is 90,000 and capital of Kamal will be 50,000. So thereby the total will be 2 lakhs. Now we have to close first. Let's see, we have closed revaluation account. No, we have to close the revaluation account first. We will close, before closing the capital account, you have to close the revaluation account. The total is 20,000. You can see the debit is less, the credit is more, so the bigger figure will appear on the both sides and this will appear as a balancing figure. So out of 20,000, that is credit total minus total of debit, which is 400 plus 800, 1200. So 18,800 comes out as the balancing figure, which is the revaluation profit. Since credit total is more, it is a profit which will be distributed among capital account old partners in old ratio. So 18,800. You can see here 18,800. Let's distribute this profit among all partners by crediting the capital accounts. So we will credit the capital account by profit and loss adjustment account. So we will calculate the amount. 18,800 we have got the profit. So in the capital account I will be calculating 18,800 multiplied by what is the old ratio. It is 2:3, so it will be 2/5. So it is 7,520. Then here out of 18,800, the revaluation profit which we got 18,800, 7,520 has been credited to Amit. So what remains out of 18,800 after reducing 7,520 is 11,280. 11,280 we will write in the Bhaban's column. So the total of both will be 18,800. Let's verify it once. 7,520 plus 11,280, it is 18,800. This is the profit due to revaluation. Now we will close capital account. After closing revaluation account and transferring the revaluation loss or profit to the capital accounts, we will close capital account. First we will close Amit's capital account. So on the credit total, Amit's credit total is 1 lakh. Let's calculate it in the calculator. You can see here 1 lakh plus 16,000 plus 7,520. It is 123,520. 123,520. Let's see the debit total of Amit. It is only 60,000. So naturally credit is big than the debit. This amount will calculate the balancing figure now. 123,520, that is credit total minus 60,000. It is 63,520. And in the same way, let's calculate the total of the credit of Bhaban's credit. So 1 lakh plus 24,000 plus 11,280, it is 135,280. So the total of credit of Bhaban is only the total of the debit of Bhaban is only 90,000. Credit total is 1,35,280. Debit is only 90,000. So the total will be here 135280. Since we have to balance the ledger, we have written the amount which is greater, and now out of 135280 we minus 90,000, so 45,280. 45,280 is the balancing figure. Now these both balancing figure indicates the differences. Here in this case we can find that the old partner's actual capital is much more than the proportionate capital by 63,520 Amit and 45,280 Baban. So these both amounts 63,520 and 45,280 has to be withdrawn. Since there is excess capital, it has to be withdrawn, but they are asking or instructing us to adjust these excess capital by loan account. So they will not withdraw the capital in cash, but instead they will show it as loan. So here this loan becomes the liability and will appear in the liability side. You will write loan account. Below that Amit and Baban. So let's write Amit's amount. It is 63,520 and Baban's amount here comes out to 45,280. We'll write here in the liability side. Let's calculate and write it in the outer column. Let's calculate and write in the outer column. 63,520 plus 45,280. It is 1,08,800. So we have also closed Amit's account, we have closed Baban's account. This is the capital account 123,520, and naturally Kamal's account, the credit total and debit total are both same. There is no balancing figure here. We have closed the capital account. Let's close the cash account. You can see goodwill account is automatically closed. Let's close the cash account. So let's take the total of the debit of cash. It is 1,10,000 plus 50,000 plus 40,000. It is 2 lakh. So debit side of the cash account is 2 lakh, and since there is nothing in the credit side, the balancing figure will be 2 lakh itself. This is by balance carried down. This 2 lakh cash balance will appear in the asset side of the balance sheet. We'll write cash here. Two lakhs. In the asset of the balance sheet, we have written the balance of cash account. Now, since you can see here, we have also closed the cash account. we have closed the capital account even, and now we have to take the total of the asset and the total of the liability. Let's calculate the total. $1,40,000 plus 2 lakhs plus 1,08,800 comes out to, let's calculate it again, 1,40,000 plus 2 lakhs plus 1,08,800, it is 4,48,800. 4,48,800. Now let's take the total of the asset. 60,000 plus 60,000 plus 3,600 plus 1,10,000 plus 15,200 and 2 lakhs. It is 4,48,000. See here, 4,48,800. 4,48,800. The assets and the liabilities of the balance sheet tally. We have prepared the balance sheet. Here we have to write the date on which the partner is admitted, that is 1st April 2018. 1st April 2018. In this way, now the balance sheet includes the name of the new partner. So students, here remember always that whenever there is a clause in the question that the capitals of all the partners has to be adjusted as per new ratio, in that case we have to calculate these capitals. This will not appear as a balancing figure. These have to be calculated, which is shown in the working, and after closing the capital account we got these figures as the balancing figure. Now since the old partner's capital is actual capital is more than the proportionate capital, we have adjusted this excess amount in the way of loan account. Hope students you understood this problem. If you understood my problem, please like, share and subscribe to my channel. Thank you.